Okay, welcome to the weekly S&P 500 chart storm run through. Now, just a heads up, I haven't scripted this, so it's a bit rough and ready, but all I'm going to do here is just quickly go through the charts from the chart storm, add a little bit of extra comments and context, so let's get straight into it. First one, Happy New Month. So, it's the month of April last month now, it's May already. What is May going to freaking bring? So, April is actually good. 12.7% month over month. Turn around from March, which was down 12%. Still down year to date, minus 12.4%. So let's blow up the chart. So this is the monthly chart here against the 10-month moving average. Why the 10-month moving average? Well, first of all, that's the 200-day moving average. So if you look at it in day terms, that's what it would be, which is quite a widely used moving average. It's basically a proxy for sort of trend, I guess. If it's above the 200-day moving average or the 10-month average, you could call it an uptrend, and vice versa. If it's chopping all around, then it's a range, like that period there. So technically, being that it's below the 10-month moving average, the S&P is currently in a downturn, or downtrend, or bear market you might even call it. And also the 10-month moving average itself has rolled over, which it's quite an, when it comes to operationalizing some of these things, looking at the slope of the moving average can be quite useful as well. But yeah, so quite a significant rebound there, but yet to reclaim that 10-month moving average. So strictly speaking, if you are using that as your rule, then that's what the conclusion would be. On to the next one. US large caps S&P 500 near the top of the table in April, but also was among the best relative performers across risk assets in March. So let's blow up the chart and have a look. Yeah, you can see there. So March, it was only treasuries that managed to turn in a positive return in March, and everything else basically was negative. A lot of these different various flavors of fixed income were negative as well. So, tips, obviously anything with a bit of risk attached to it. So, IG credit, high yield, EM sovereign, all the rest of it. The point here is US large caps, and so, all the rest of these are pretty much equities and commodities. And you can see there that, as I said in the tweet, they were the best US large caps rather. The S&P 500 was the best relative performer, fell the least. You know, the cleanest dirty shirt is sort of the term there. Meanwhile, in April, MLPs are a bit of an outlier there on both months. But yeah, large caps pretty much at the top of the table, US large caps. And what was the worst equity? Worst equity was frontier markets. And yeah, treasuries I think were slight positive. Well, basically nothing, same as cash. And commodities were a slight negative, which probably would be surprising, but that's a broad commodity index which I'm using there, rather than just WTI, which we all know what happened there. Number 3, another angle on the April versus March price action. So what we're looking at here is the net gap direction over 1 month in the red line there, and the takeaway there is stocks gapped down the most ever in March and up the most ever in April. So welcome back volatility is kind of the punchline there. I guess, and macro charts there, at macro charts, you should follow them, definitely worth a follow. What they mentioned in the original tweet was that when you get this kind of sort of earthquake in the data, and it very much actually looks like an earthquake drum, with the little needle moving back and forward, and when you have this earthquake and volatility or volatility quake, it quite often can actually occur in a transitional stage, or a transition in market regime. So for example, if you can look at the dots here, well, the pullbacks are kind of like when it didn't really do anything, but those bear market and bull market dots there basically just illustrate the point that big swings in this indicator can be indicative of that change in regime. So quite an interesting one. Number four, hedge fund positioning in S&P 500 futures turning down into net shorts. So I've sort of quipped there or questioned there is a transition from a buy the dip to sell the rip regime. And certainly, if you did move into a bear market phase, an extended bear market, regime, um, that would be kind of the standard operating procedure there. If you're in a bull market, the standard operating procedure is basically buy the dip, from a market timing standpoint. And if you're definitely in a bear market, or if that's, your frame of reference is that's what you believe, then that's kind of the winning strategy. So it's sort of an interesting thing, and it very much reflects also what I'm seeing across a lot of other surveys and other positioning data that shows definitely certainly larger investors as well, and insto investors. They're definitely very much lighter on the positioning in terms of risk assets. Load up the positioning there. We'll go to 5 and then we'll come back to 6. Another angle on the ERP, which is the equity risk premium. So Damodaran, obviously he is very much worth following. If you have studied finance, you probably read his books. But anyway, look, he's attempted to adjust for the impact of the pandemic with the COVID ERP. And so, yeah, we've seen some pretty big shifts up and down in the equity risk premium. And the big question, or the takeaway is there enough of a cushion to take on equity risk now? So we'll just explore this very quickly. So the black line is kind of like the standard or the headline ERP. I think there's about a dozen ways to calculate the ERP. I've seen a lot of different ways, but we can get into that debate at a different time. Anyway, we'll just go with what he's used. The grey line there is the COVID ERP, so it's computed with blah blah blah, but it assumes a 30% drop in earnings in 2020 and a 75% recovery by 2025, so quite conservative. And it's obviously it's going to be a lot lower than the other one. So I guess you would say that when the virus kicked in, was probably the time to sort of switch over to the grey one, maybe, if you assumed that that was the right way to look at it. And it's not all that much higher than back then. Whereas, but even then, even if you look at the black line, it's come down quite a bit as well. So that equity risk premium, that cushion for or compensation for taking on equity risk over treasuries is shrinking. So again, it leaves that as an open question. On my calculations, it still looks pretty good for what it's worth. Number 6, US zombie companies outperformed the S&P 500 by a historically strong 7% in April. And, basically that is a sign that Fed policy is working. So let's dig into the chart. And what you've got here is the performance of the zombie companies, which is companies where EBIT to interest expense ratios, 3-year average, is less than 1. So, they're basically not really able to pay, afford their interest payments. And market cap above 300 mil, so that must be just to sort of get rid of the rats and mice. Anyway, in S&P 500 along the bottom, the returns there, so you'd expect them to be correlated because they're they're very, very similar things. Obviously one's a little bit lower quality. But yeah, as you can see these dots here, so Ben there has also, we'll bring it up there, also a very worthwhile follow. As you can see there, the dots up on the top right, or the sort of outliers there is when zombie companies are outperforming S&P, and that is pretty much, when the Fed is really getting things cranking. When it comes, because a lot of this is really down to access to credit. So, when the Fed starts putting the foot on the gas and you know, getting credit flowing again, that's obviously going to disproportionately help these ones. And you know, they're actually also going to fall further as well, which as we saw before with MLPs, the further the fall, the lower the bar it is for rebounding, or you know, painting outsized returns because of a lower base effect. Number 7. So this is really quite an interesting set of charts here. It's another angle on the matter of concentration, and you know, there's been quite a few charts going around lately about how concentrated the market has become. Like, you know, what portion that the top 5 companies of the S&P are now making up, and you know, for the charts that don't go back further than 1980, it's at record levels, and you know, it's all very astonishing and shocking and sensational. But then if you look back a little bit further, it's actually not as shocking. You know, you might even say that if you assumed that 20-year period from 1960 to 1980 was kind of normal, you could actually assume that you could actually argue that things are getting back to normal. Or you might actually argue that, you know, they're just moving back to long-term average. But yeah, it's 4 different measures here. That top 5 here is the one that you're all familiar with. The bottom number equivalent to the top 5. It's a kind of another interesting way of doing it. Gini coefficient, students of economics will remember that one. Here's the definition here. I mean, it's basically a measure of inequality among values of a frequency distribution. There goes the Wikipedia page. You can read it up on your own time. The HHI, Herfindahl-Hirschman Index, which again, it's a measure of competition or concentration. It's typically used in you know, determining whether or not an industry is, you know, been taken over by a monopoly or monopolies kind of thing. But again, I'll let you read more onto that in your own time. The point is, concentration has actually gone up, so it's definitely correct to say that concentration has gone up. It's a lot higher than it's been in the last, well, definitely a lot higher than the average of the last sort of 40 years, so that is something. Moving on, number 8. S&P 500 just clocked up its largest ever bear market bounce. Is the bear market over? Was there even a bear market in the first place? So it's an interesting table here. So the current collapse and then rebound. Well, one thing actually to highlight, and you know, there was a lot of chatter about this earlier on, is just how rapid it was. You know, not drawn out at all. And but anyway, if you look across these different bear markets here, it was the biggest bear market bounce. But then, you know, 31 versus 27, we're not really talking about a massive outlier here. Does this massive rebound preclude or, you know, spell the end of the bear market? Well, given that it wasn't that far removed in terms of the magnitude from, you know, the 07 to 09 period, you can't really rule it out that, you know, the bear market is still, you know, in play. But at the same time, you know, the speed of it kind of does give some, you know, weight, or give some reason to consider that was there even a bear market in the first place. You know, normally bear markets are, well, certainly I would think of a bear market as something that unfolds over a sustained period of time rather than a crash, because we really just went through a crash. I mean, it was a crash. It wasn't a long drawn out, you know, procession of falls. It was just a big bang. And so, you know, I think to get excited about the idea of a bear market, I think you have to really believe that things don't bounce back, as I think that a lot of people, are, myself included, are kind of holding as the base case. You know, the pandemic impact is fundamentally temporary. Um, yes, we can get a wave two, um, and that is a concern. There's definitely downside risks, so I'm not going to be complacent at all. But it's base case, it's fundamentally a one-off temporary thing, and meanwhile you've got historic, massive, globally coordinated monetary and fiscal policy stimulus. And you might even make the case that it's going to result in an overstimulated economy down the track. That could be as short as a year from now, maybe even less time. It's not going to, I mean, obviously all that stimulus, and I'm not making the case here that that stimulus is going to offset right now what's, that the shutdown of the economy, because you know, you need a active transmission mechanism for things like cheap oil, like very cheap petrol prices don't really work unless people are actually driving and flying. And likewise, very low interest rates don't really work if the banks are too scared to lend, or if people can't or won't, or indeed are even themselves too scared to borrow. So hence why I say that the overstimulation thing might come afterwards. It's a bit of a crystal ball gazing exercise. I mean, that's kind of my base case. I'm running with that for now, and but as for the markets, I mean, the markets are facing a wall of liquidity, and it's probably going to put a bit of a floor. And I guess the point of debate would be where that floor ultimately lies, because definitely possible that we get another run down. I think that we get definitely corrections, but to get a big bear market, you need to see, I think, a lot more going wrong, and perhaps a bit more signs or a bit more clear evidence that it's not going to be a temporary thing, that the impact's going to be much deeper and longer than expected. So that was a long drawn out way of explaining that one. And by the way, it's not actually the biggest rebound, not even close, as Duncan Lamont points out. He's done some work there, so again, there goes the link. You can read it on your own time. Number 9, here's what it would look like if the Great Depression happened again. Now, before I even look at this chart, I don't think that's going to happen again. I don't. I probably should have put a little bit of disclaimer in this tweet, and I think it's really hard to argue that you could get anything like this. I think, yeah, it's just, no, it's not going to happen. But anyway, even if it did, this is what it would look like if you basically superimposed that price action from the Great Depression onto modern times. And that would bring you back to 1992 levels. Last one, and this one I actually think has a pretty strong, decent, like very good chance of actually happening, in contrast to the previous one. So a good reminder that it's not just bull markets and bear markets. Sometimes you get crab markets. I don't know if people have come up with that term before, but I'm going to go ahead and trademark that right now. So yeah, markets that just move sideways in a grinding range. And also, yes, it happened in the 60s and 70s too, Vince. Indeed. And that was actually another good analogue for this period. So, probably a good sort of market period to study up on. But this here chart shows you the price action from 1917 to 1927. And yeah, markets can just, you wouldn't, I don't know if you'd necessarily call that there a bear market. You'd call that, obviously, towards the end period there, more of a bull market. But, you know, things can range. They can range for longer than you expect. And it's not something to necessarily get sad about, because these kind of ranging markets can actually turn up some pretty solid opportunities for active investors. Play the range.